अच्छा अभी भी सिलीगुड़ी
जी जी. Okay,
वी आर
so we're
लाइव
live. Yes, we're live. So welcome everyone at the first official episode of Stocks पे Charcha by Etika Invest, and we have our first guest today, Mr. Shoaib Zaman.
हेलो हेलो ओके आई थिंक वी हैव लॉस्ट अब्दुल्ला सो So let me introduce myself. My name is Shoaib Zaman. I used to be a journalist a long time ago. So I used to be a journalist uh, for about 7 8 years, covering basically financial markets and investments. And after that, in 2015, I joined the mutual fund industry as a product com person, wherein my work was basically to write about mutual funds, about different products, explaining the products, helping out the sales team, helping out the investors, working with the. Hi, Abdullah.
Hi. So let's just start from the beginning. ठीक है?
Okay,
I
ठीक है.
completely lost the connection. So
I
welcome everyone.
was already introducing myself.
Acha, then please go on. Please go on. Please go on. Please go on.
But ठीक है. Uh, uh, even for you, I'll just do it again. So that's not a
Okay.
problem.
Sure. ठीक है.
Okay, so I started out as a journalist way in 2008, just when the world was crashing. And luckily, I got a job at that point of time with a company called Value Research. And it was a great learning experience because that's where I ended up learning a lot of things about stocks and mutual fund, both of them. And then over a period of time, I have worked with many different news organizations. And then after 7 8 years, I kind of decided to shift industry and move into mutual funds. It was more like a lucky break. In the mutual fund industry, I was part of the product communication team, wherein I had different roles, as in depending upon which segment of the product communication or product team I was working with. So there was a portion wherein I used to help. Uh, you know, Sometimes fund managers they'd use a lot of technical jargons, and for normal people, it's not so easy to understand. So I would be more like someone who would translate things into a much simpler way and assist them in putting out the right communication to the to our investors. At the same time, sometimes people may have question, or let's say the sales team will come back with certain questions, and so I'll synthesize everything and bring it to the fund manager's notice and ask them to explain it. The second part of the role was basically to design products, which product can be launched, what can or cannot be done, and basically work with everybody in the team. It was more like a team effort, wherein I'll be assisting everybody, and all of us will work together to ensure that the compliances are fulfilled, the products are in the best interest of the investors. So that was the role, and that's where I worked for the next 7 8 years. And recently, I have left all of that, and I have started on my own, wherein I write about stocks, investment products, and uh, and uh, basically help out other people with their investments.
Right, right. Can you also talk about your role in India today?
Sorry. Okay. With India Today Group, I was working for their magazine called Money Today, and sometimes with the Business Today magazine. और वहाँ पे my role was basically to write about investments and investment strategies, as well as highlight about what stocks people can buy, what is it that they can do with on the personal finance front.
Right, right, right.
So
Fantastic.
those were the primary responsibility.
Fantastic. You have been in this industry for a total of how many years?
So I have worked, if put together, the combined experience would be around 16 years, 15, 16 years.
16 years. Fantastic. You have seen all sorts of market cycles and how the markets have evolved in India over the last 16 years.
Right.
Very
So
good.
in this period, let's say I started out with great financial crisis, GFC, 2008, and then after that, everything that has happened in between. Like recently, if you look at it in the last 3 4 years, we have seen too many events. And prior
Hmm.
to that, also there were a couple of events, major ones. So yeah, so seen all of that.
So, I'll just go on a little bit of tangent over here because you mentioned
Hmm.
that you started your career with the global financial crisis of 2008. Uh,
Okay.
I know one person, another senior person in the industry,
Hmm.
right? Uh, he started his career in around 1999, near the dot-com bubble, you know.
Okay.
And like when he was starting out in the stock market, he saw the dot-com crash. Uh, and then he also, a few years later, saw the global financial crisis. So he said that, the beginning of his career, he faced two of the biggest crashes, one after the other. So that really sort of made an imprint on him uh, of markets crashing. And like that's not a very healthy imprint. And so he has been a perpetual bear, or at least not a bull, when it comes to the stock market, because his initial years were, molded like that.
Hmm.
So what would you say? Like you started with the global financial crisis. So did that have an effect on how you look at the markets?
Definitely. How people start their career in the financial services industry and the segment that they start with has a huge impact. Like I have worked with a colleague who started out in 2014 or 2012, whenever, and he started out on the debt segment. Okay.
Hmm.
Now, every time you have a conversation with him, he will talk about, while he understands stocks as well, he has a bias towards debt segment. And because he has seen a lot of people make a lot of money, especially between 2014 onwards on the debt side, So he thinks it's a fantastic place to be in, and that you can generate as much alpha as probably equity if you are investing into even if you are investing into fixed income.
Mm-hmm.
Now that so it people do get influenced, and I wouldn't say I did not get influenced. Even I have one of the reasons, because I started out in 2008 and I've seen the worst. The fear that people may have in the job, where you don't know if next month you will retain your job or not, and that fear is so real that when you are working or when you are looking at financial services or finance as a whole, you tend to be a little more cautious, and that has also
Can
impacted
you
me.
repeat this job part? Like, can you repeat this job security?
So in 2008, a lot of my friends, when we, so most of us got job right after 2008, after graduating. Within the next 3, 4, 5 months, most of us did get their job, but many of us also lost our job towards the end of 2008.
Mm.
And some of the people who couldn't find job till July, I don't think there was anyone in my batch who could actually find a job in that year or even in 2009, because while markets started opening up in 2009 and there were more offerings, but then by that time you were like, you were for 1 year you were out of action, and you weren't doing anything, and you had a new crop of freshers coming into
Mm.
the job foray. So suddenly you get that advantage, and you don't have that advantage. The freshers will have far bigger advantage. So
Okay.
people in my
Okay.
batch had to see a lot of tough time, and that happens every time, I guess, until unless some people they're super smart, so they end up upskilling themselves and ensuring that there are no gaps.
Mm-hmm. Okay.
So similarly, when it comes to investments also, so one of the great things about, you can say, the advantage of being a journalist was that you get to interact with a lot of people. Okay.
Yeah.
And you get to interact with all types of people: professional investors, non-professional investors, people who are basically investing on the sidelines or out of their pocket money or whatever. And one interesting thing that I have come across is that there are many people who started out investing in 2006 and 7, and after seeing the crash of 2008 they actually said, okay, no more investing. I am
Mm-hmm.
this is a gamble den. I have already lost too much, so I'm not going to do anything more. So
Yeah.
I've
Yeah.
also come across those kind of people who now do not invest in stock markets. They will put money in FD, they'll put money in post office savings, they'll put money into their own business, but no more investments.
Right. 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 So, Shoaib, coming, developing from the global financial crisis story, now we are in 2024, February 2024. The markets are
Hmm.
at its all-time high. What are your thoughts on the current market sentiments? Is it a bubble, or is it a solid growth story backed by solid earnings? Is the structure of the Indian economy is changing? Some people say from a service-oriented economy to now more of products. So what are your thoughts on that?
So, so let me first break it up into many different ways. One has to understand that that markets do change. Like it's a very famous saying.
Yeah.
Uh, you know, so one of the most common examples are that things are different, but it's also the same at the same time. Okay, things don't change a lot. So
History
if
doesn't repeat, it rhymes, something like
Hi-
that.
yeah, history doesn't repeat
Yeah.
itself, but it always rhymes. Okay. Now, if we start looking at it from that conjecture, we will realize that actually there is a lot of truth to it. For example, um, crashes. If we see the last 25, 30 years itself of the Indian stock market, we have seen at least three major crashes. We've seen one in 1990, one in 2008, and one in 2020. Okay, so crashes always happen. The second aspect is, um, it's not that the crash always happens in the same segment. So while we are saying the market of 1990 was very different from 2008. So in 1990 we had the entire IT industry which was doing phenomenally well. Okay, the valuations that was it was bizarre valuation. I think a few years back there was a report that I came across which I found very interesting, that Wipro managed to achieve the same. If someone had bought Wipro in 1999 or early 2000, and then they had to wait for some 18, 20 years or 21 years, and that's when they would have actually made their money again. Otherwise, throughout that entire period, they wouldn't have made any money. So this is reality. कि ठीक है, if you buy at a very high price, there is likelihood that you are not going to make a lot of money, and that things can be very different. But uh, so so let me actually bring on to the real point. So in 1990, if my memory serves me right, IT stocks comprised of around 30% or so of the Sensex. Okay.
Okay.
In 2007, if you look at it, I think infrastructure as a whole had a far higher weightage in the stock market. In 2020, if you look at the Sensex, or let's say Nifty 50, the major index, financial services had a major lion's share of the stock market. So the stock market may remain the same, but the underlying has constantly been changing. So
Yeah. Yeah.
each time when the markets have crashed, what has crashed is whatever was the maximum portion, and that's where the
Right.
bubble was
Right.
actually there.
Mm-hmm.
So so what is so the moon point is that one has to understand that market as a whole is not, well, it's rare that everything in the stock market will be overvalued. It may happen that certain segments may be overvalued and some segments may be fairly valued, and maybe
Right.
there may be nothing that is even fairly valued. That's the worst that will happen, that
Mm.
nothing is undervalued. But it doesn't happen that everything is overvalued at all points of time. Okay, so when you are looking into the stock market, you have to see you need to see it at a cross section level. You need to see which segment of the
Right.
market is overvalued, and it's best to avoid that. So if we look at it today, uh, purely from an index point. So I keep doing this study every 6 months, somewhere between around December, January, and then again around June or July, where I look at every segment of the market and see uh, how what is overvalued and what is undervalued. So one of the things that I've come to understand is the last time when I did this in December, it was the mid and small cap are clearly overvalued. Okay.
Okay.
The Nifty 50 portion is basically fairly valued. It's not overvalued, it's not undervalued. So if you think you would want to buy Nifty 50 and you can make some great returns, the probability for that is not very high. If you think you would want to invest into Nifty 50 and you are going to make some you are going to lose your money, that probability is also not very high. So by far and large, we are very fairly valued on a Nifty 50 basis.
But don't you think, like you said, that within a index, not all stocks are overvalued and not all stocks are undervalued.
Hmm.
So, for example, within the small cap index or within the mid cap index, maybe certain sectors are overvalued, For example, let's say the financial sector stocks, or let's say the railway stocks. But at the same time, can we say that certain sector stocks within the mid cap and small cap might not be as much overvalued, or might even be fairly valued?
That is true. In fact, I think so. There is a segment in the mid and small cap which is overvalued, and most of them I find them at fairly value. So recently, I was actually looking around some random set of companies, and my takeaway was that on a 5 year basis, uh, for most stock, I don't see that people are going to make a lot of money with mid and small cap. From a 10-year basis, I think they are fairly valued. Okay.
Okay.
Uh, the implied earnings potential that is there. Okay. Looking at your current valuations, it seems that over a 10-year period, the likelihood of you making money with small cap and mid cap is still there. But on a 5 year basis, I don't see that happening until unless something dramatic happens. Like I don't know. It's very difficult to pinpoint what has to happen. But perhaps that earnings that is coming right now, it keeps going on at the same pace, or even it outpaces itself.
Mm-hmm.
But it seems very unreasonable because I don't think, be it manufacturing or most of the B2B businesses, they have that potential uh, where earnings will continuously increase, because that probability will only happen if your inflation remains high. So I think the bigger question is, do you see in the next 5 years inflation at around 10 or 12%? If one doesn't see that, I don't think that valuations will sustain
Right. Okay.
in that segment. But definitely there are few stocks which are decently valued. There is no harm in, like, it's fairly valued. So if even if someone buys it and like holds it for 10 years time, they will definitely make enough money out of it.
So, okay, this is a very so a very subjective question. When you say enough money, what do you mean?
So okay. So the first question would be, okay, how you are setting your expectations. I think on an average, setting up an expectation that you are going to make around 10% uh, 10% CAGR returns over a 10-15 year period, or somewhere between 10 and 12, or maybe 10 and 15, okay, is a reasonable expectation. Okay. And that is something that is achievable. So from a 10-year perspective, making 10% or 12% CAGR on your mid and small cap is possible.
Okay.
But
Some
that will
people,
not be a linear. That will not
yeah,
be linear, right?
some people who have come to the markets
Huh.
in the last 2, 3, 4 years will hear that 10% number and say like, what are we talking about? you know, because everyone has been making 20, 30% annually, or even more recently. But as you said, that's not normal over the long term, right? So that's something very important that people need to understand.
So a lot of people, they ask me, like, sometimes when I do these investor education kind of you know engagement with individuals or with a group of people, sometimes people ask me, okay, what is it that we should expect, how should we set up our expectations? And my simple response is that the way to set up your expectation is for stocks and for fixed income is you need to understand what is the driving factor. So for stocks, it will always be inflation plus around 4%. So if you can figure out what your expected inflation will be for the next 5 years or 10 years or whatever time horizon you want to set up, okay, more than 5 years, you add up another 4 5%, because for a business to make, so let's take it from a very very basic point. No business can ever sell their products below inflation rate, because if they start doing it, then it's understood that they will have to shut down their shop,
Right.
right? So now you are forced to basically ensure that whatever, if you are selling something for 10 rupees, it already has in it, okay, this is the inflation of 5% or 6% or whatever. It's already inbuilt, because if you don't sell beyond inflation, you will have to shut down your shop, and that's the hard reality of life. So you are going to add up some extra markup. That markup will be what? In some years it may be 10%, in some years it may be 15%. But on an average, worst case, some businesses, they will lose, they will burn their cash, and then they'll shut down. So when you average out everybody, you will have perhaps somewhere around 4 to 6%, or maybe 5% plus minus 2 3%. That's the kind of expectation you can build into your business. So a simple business must give you returns which is over and above inflation of around 4 or 5%, maybe 6%. If it can give you far more than that, it's great. You have found yourself, you know, the duck which gives a golden egg, something like
Right.
that. But but on a fair basis, that's the minimum expectation you can easily set up. Now on fixed income side, what is the main underlying? The main underlying is your interest rate. How the interest rate is being set up by your central bank, and what is the trajectory, because that will decide what your FDs are going to give. That is going to decide what your bonds are going to give. That is going to decide everything that is happening in the fixed income side. So if for the next 10 years you can define ki how what will be the trajectory of the interest rate, okay, then you can say ki theek hai, whatever is the trajectory of the interest rate, based on that you can easily say ki theek hai, this is what you can expect from your fixed income investments. If you think you can predict these two things, then you can set up your expectation. If you think uh, you can't put up a number to this, then I think the fair number will be to just look at कि अच्छा, what is the last 15 20 30 years 50 years of what does history tells you over a fairly long period of 15 20 or maybe 30 years. So Benjamin Graham used to say that statistics, okay, financial statistics of less than 25 years is not reliable.
Okay.
To build up any real expectation and to set up your understanding, you need to have at least 25 years of data, which I think is fair. Maybe one can put up 5 or 10 years here and there, so maybe 20 to 30 years of
So
data
don't
if
you
you can
think
easily
that
see.
when someone says that financial statistic of less than 25 years is not reliable, but uh, now I'm just a nobody, but
Yeah,
I'm
no,
just
no, no, sure.
presenting my thoughts on this. Key 25 years ago, for example, in case of India, if we talk about, then the very structure of Indian economics and Indian exports and imports and Indian products and services was fundamentally different from what it is today. So it does not uh, make sense to incorporate statistics of a bygone era, which is completely different in its working, to make
No,
assumptions
no,
about today.
correct. So you have a fair point over there. So let me clarify it in on certain aspects. What I'm saying is that when you have to build up an expectation of what your inflation will be, how your interest rate trajectory will be, you should look at that longer period. It will make much more sense, because and you should also look at what has happened globally in different markets over a similar period, because what we are doing in India is not something new. We are still a developing country, and there are many other countries which are closer to being a developed country, and then there are those which are developed countries. So if we look at all three of the stages, it will start giving us a sense, okay, what is it that we can expect? As far as history for a financial market is concerned, on an aggregate basis, it makes sense to look at a fairly long period. Why does it make sense? Because look, there are certain things which don't change. Greed and fear, the way we behave, or humans in general behave. Okay, this hasn't changed today. What we are doing today is not anything different. What people were doing 2008 is not very different from what people were doing in 99, and it's not going to be
Right.
very different, right? So that core behavior doesn't change. So you can
Right.
look at all of these numbers to see how the rhyme is.
Hmm.
Don't expect it to be the same. It will not be same. It will not be a photocopy, but it will give you a sense, okay, what is it, how you can set up your base expectations.
Right. 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 Bilkul. Got it.
So if so a lot of times people get confused. There are many smaller things that or many nuances that come into play. uh, let's say, for example, if you look at, with be it India's history, or we look at how things are happening in US, okay, you will get to see you will get to see that, just a second.
Sure.
uh, so if you look at it, sorry, I got a little distracted. um, where were we talking?
You were talking about why we should look at a longer horizon of investment data and uh,
Aha.
yeah.
So if you look at it, the underlying structure of Nifty and Sensex has changed. I
Hmm.
agree. But if you look at the base statistics, the pace at which your earnings growth was, we are not looking today at earnings growth which is better than what was happening in 2000, between 2004 and 7. Okay, this is not something very
In the
different
large
from
cap
what
segment,
people.
right? But have the things not changed in mid cap and small cap in terms of earnings growth?
We don't have enough data.
Okay. I think we lost you there. Just so while Shoaib is joining, you guys can post some comments and some questions in the comment section, and I'll be happy to uh, take uh, take those questions and answer those questions while he rejoins in about 2-3 minutes. Any questions? Anybody?
Yeah.
Okay, nice back. Yes,
Sorry.
yes, we can hear you now.
Okay. So we don't have long enough. Sorry, so the parameter that data is taken,
We cannot hear you, Shoaib bhai.
Am I
I think
audible
there
now?
is some background noise that's coming.
Abhi, still?
Yes, it's fine now. Yeah.
Okay. So, so we don't have long enough of a history to say it with. If you look at the Nifty, I think mid cap and the small cap TRI data is only available from 2004 or 2005. Okay. The BSC, I think the NSC mid cap will not be more than will not be older than more than maybe 2001. So our
That's
biggest
long
problem
enough
is that
data.
we
That's a long enough data, isn't it?
no, it's not long enough of a data because that data is even when it is there on an aggregate. The question is that whenever you see any series, it's best to assume that the first 3 4 years or maybe 5 years of data may not be very clean because it takes time. If you look at it, I think there are a couple of changes that has happened even in the way the index has been calculated in the last 3 4 months or 5 months. Earlier, they were taking, I think, a consolidated, standalone earnings, and now they have started taking consolidated earnings, or it's the other way around. So, whichever way it is, the point is that once you change these data, these things that you don't get to see it instantly, you get to see all of these things over a period of time. So it takes time for you to even see and learn and understand okay, what is actually happening and why is it that we are using a particular set of data.
Right, 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 right. Okay, Shrebai, so I think we have spent half an hour talking about market sentiments and history. Let's just spend the last 10 minutes or so
Sure.
discussing about if someone wants to, get into the stock market, select their own stocks, do active stock picking. So, in short, if you can guide people on how do you pick stocks, how do you construct a portfolio, and when do you take an exit from a stock, so that will be fantastic.
Sure. So as far as stock picking is concerned, I think one thing which is very important is uh, how do you see yourself? Like I am someone who cannot sit in front of the screen and look at look at ticker movement throughout the day. So day trading is not for me.
Right.
Now I am the sort of person who will think over and see okay, why is there a discrepancy? Okay. And then so let me give you an example of a stock where I was bullish at a certain point of time and now I think it's fairly valued and it's not so much as a uh, this is don't consider this more like a recommendation. This is more from a
Yes, yes,
learning
of
perspective
course.
that one has to see. So a few years ago, about 3 years or maybe 2 years back, if you look at it, the stock of ITC was not moving anywhere. For 10
Mm.
years, I think it had remained in a very narrow range, and the earnings had gone up every year. Okay. Now, the story over there was very simple. One only had to, and it was a stock which was throwing a lot of dividend every year,
Mm.
and its dividend yield was also increasing because the price wasn't going anywhere, and
Right.
and the dividend amount was going up because of your EPS growth. Okay, and so it was a very clear situation that people haven't seen, and the only reason why nobody was looking at it was they had other interesting stuff maybe to look at and to read up, and I think that's where the opportunity lay. So the simplest thesis for buying ITC maybe 2 years or 2.5 years back was that look, it's a great business. All its underlying business is doing great. The only problem is that you have a cigarette business which is throwing a lot of cash, and you have other businesses which is not giving uh, as much return on equity. So a smart CEO, whenever that smart CEO will come, will all he has to do is just say, "Okay, we are not going to work as a conglomerate or a diversified company, but rather I'll have different companies listed, and each company will be listed directly, and or sell off the non-profitable or the less profitable business, and that itself will ensure that there will be value unlocking. Now, as long as that value unlocking does not take place, you are going to get regular dividend, uh, which is far higher than whatever is Nifty 50 giving you, or Nifty 500 is giving you. Typically, your dividend yield for Nifty 50 or Nifty 500 is between 1.5% to around 2.5%. That's the range. If you are getting more than 2.5%, you are extremely lucky. If you are getting less than 1.5%, obviously uh, you shouldn't be investing. So that's the broad range. Once you compare it to ITC, that was around 3.5, 4, more than 4%. Okay, if my memory serves me right, it was more than 4% at that point of time, and that was the simple play. You just buy it, you need to sit on it. Either the price will go up, because other people, there are many other smart people who will also notice it, and you just have to sit. And let's say if it doesn't go anywhere for the next 5 years, you are getting very good dividend every year, and then you can reinvest that cash somewhere else. So this
Right.
is the kind of play that I am looking at. I think I am someone who looks at how what is it that is being mispriced in the markets. Now, each time when I'm investing, I usually have a very clear thesis as to what is it that I'm expecting from it. Is it, there are only two or three types of stock in my view, or in the way that I approach markets. Either it's a stock where you should just buy and sit down because earnings is going to keep growing, and the bet is more on the, maybe on the management. Okay, or it's about the quality of the management that you are betting on. The business may not be doing well today, but that's okay. Every business has a cycle. Maybe today is a bad cycle, but the absolute bet is on the management, on the CEO. So as long as that guy is not getting changed, I am totally in with it. The other is that I find these kind of special situations where I think that until unless this particular event does not take place, I can remain invested. Like in the case of ITC, the event was very simple. Either it demerges into different entities, or the price goes up so high that your dividend yield falls to maybe 1.5%, or close to whatever the market is giving, because then
Mm.
you have nearly realized everything in the current phase. And then the second phase, whenever it happens, we don't know. So if you have a better idea, you might just as well get out from here and go somewhere else.
Right,
So
right. So
these these
if I
are
were to summarize, yeah, yeah, please go on.
so these are the kind of things that I'm looking at. So for me, the exit thesis is very much clear right at the start. Okay, but it's not always that this happens with me all the time. There have been cases where I have been horribly wrong. For example, uh, when Yes Bank went into a crisis, I had a very simple thesis. Yes Bank is a fairly large bank. The government is not going to let it, go bankrupt or close down its shop. It is going to be saved. So the question is, uh, what would be the right price to buy? And I bought it at some price, and I don't remember the pricing and the valuation. But I made a purchase with the expectation that this can fall for another 25-30%. But guess what? In the next 2 months, it fell by another 50%. And that's when I realized, this is something that I don't know. Either there is something that I don't understand, or there is something else that I'm missing out completely. Wherein
Mm.
I got out of the stock with my 50% loss, accepting it, And then the way it played out, it became quite apparent that I was right on the part that the government is not going to let it fail, but I was wrong on the part that the shareholders will get away unscathed. That did not happen. The government actually diluted the stock. Uh, they saved the depositors. They ensured that the shareholders paid the premium of investing in equity, which is okay. ठीक है.
Yeah,
It's part and parcel. So something like this can always happen when you are investing in a special situation. So you need to be very clear कि ठीक है, at what point you are going to say कि ठीक है, I don't understand and something is happening that is beyond my comprehension. So just
right.
accept your losses and you get out.
Correct, correct.
So
Any जी जी बताइए.
so for most people, what I would suggest is that when you are investing in any stock, be very clear and write it down. I tell all the people, all my friends, any of the clients who come to me, that make it a point, make it a habit that before you even invest a rupee, you have it written as to why you are buying it, how you are seeing it going forward, 1 year, 2 years, 5 years, whatever your time horizon is, whatever you are understanding of it, and followed by what is the up on the downside at which you will exit, because there is something that you haven't understood,
Right,
that you haven't invested. If something like that happens, you need to be very clear कि ठीक है, you would have made 100% returns, you will still get out because that's how you have planned yourself. And or you would have lost 50% of your principal and you would say कि ठीक है, let's get out because I can't understand this thing. So as long as you have written it, what will happen is that your decision making will be very clear. It will be easy for you to understand.
right, right.
Because once you have invested, most of us, most human beings, uh, we will all be like we will all get influenced by our emotions. Are I have made 100%, maybe this stock will go up to 200%. You will start selling yourself some story which may or may not be there. But if you have
Right,
written your decisions very clearly कि this is what you are going to do when this thing happens or is achieved, then you only need to execute it, and it's
correct.
best to execute it.
Have systems in place, basically.
Yes, have systems in place.
Right, right, right. Okay, Shoaib bhai, thank you so much for your time. There was a lot that we covered in this session, right from the global financial crisis and long-term investor expectations that should be there when investing in the stock market, how to pick stocks, a lot of things that you shared about the industry as a whole. Inshallah, we'll have you again very soon, and we might discuss on certain other topics that I wanted to discuss today itself, but we are running short on time. So you run a blog, right, called Navigator RA.
Right, it's a substack that I run.
Right, right, right. So I would, recommend our viewers to go check it out. And you also uh, are an advocate of faith-based investing, right? So
Right.
there, I
uh,
think the blog people can read more about it.
uh, yeah, so people can read maybe on the blog, but I haven't written as much about it on the blog as I have conversations around it, because it's a very small community which will follow faith-based investment. In my understanding, if I look at it, I think there are only three serious communities which are looking for such kind of investment solutions. Either your Jains, Christians, and Muslims. These are the only three communities I've come across who are fairly serious, and even among them, there is a small sub segment of the population
Right.
which wants to spend time to understand on how one can invest as per their faith. and it's not something very common in India. Actually, there aren't as many solutions in India, so which is where I am taking up a lot of effort and uh, trying to connect with as many people who are interested in this to hold conversations and to help them design as to or figure out as to which products are compatible with their belief system.
Right, right, right. Fantastic. So, inshallah, next time when we have you on the podcast, we'll discuss more about your approach to faith-based investing and how you would
Sure.
how you look at how you filter stocks for faith-based investing. What are the expectations in faith-based investing? What are some of the products that you might recommend? And
Sure.
another hot topic that I wanted to touch on, but we'll touch on it next time, is your take on the current SME stocks. That's also a very uh, hot topic these days.
You're
So we'll
right.
cover them next time. Thank you so
Sure.
much for taking out
Thank
the time,
you.
sharing your insights with us.
Thank you. Thank you for inviting me, Abdullah. Thanks so much. Chalo.
Thank you so much.
Okay. Bye. Bye. Khuda Hafiz.